Imagine this. You're about to buy a business, and not just a stock, but a real brick and mortar business. You'd want to know its profits, expenses, debts, and future potential, right? Yes, most traders jump into stocks without ever checking these things. Today we're diving into fundamental analysis, the key to making smarter stock picks and avoid financial disasters. Let's go. Fundamental analysis is the process of evaluating a company's financial health, business model, and market position to determine if a stock is overvalued, undervalued, or fairly priced. Unlike technical traders who stare at charts all day, fundamental investors dig into numbers, reports, and economic trends. Think of it like dating. Do you want a relationship built on solid values or just a fling based on vibes? I'll leave that up to you. Part 1, the financial statements. All right, every company releases 3 key financial statements. Let's break them down. Number 1 is the income statement, aka the profit and loss statement, or the P&L. This shows revenue, expenses, and net income. Key metric, EPS, or the earnings per share. Higher is better, but check if earnings are stable or it's just a one-time fluke. Number 2, balance sheet. What a company owns and what a company owes. We got the asset where we have the cash, real estate, inventory, and then we got the liability where we got the company's debts, accounts payables. Key stock metric, debt to equity ratio. Too much debt, red flag. Too much asset with a conservative amount of debt, okay. Number 3, we got the cash flow statement, or the company's lifeline. We got the operating cash flow, healthy business activity, and then we got the investing cash flow, spendings on assets and acquisitions. And then we got the financing cash flow, and it's for debt repayment, dividends, and stock buybacks. Key metric, the free cash flow, or the FCF. This is king. High FCF means the company has cash to reinvest and reward shareholders. Part 2, key valuation metrics. Let me ask you a question. Would you pay $100 for a $50 hamburger? No. And that's why we use the valuation metrics to know if a stock is overpriced or undervalued. Number 1, price to earnings, or the PE ratio. It compares a stock price to its earnings per share. High PE means a stock is expensive, but it may be for a reason. And low PE means a stock is cheap, but for what reason? Number 2, the PB ratio, or the price to book ratio. If the PB is less than 1, the stock might be undervalued. Number 3, dividend yield. If you love passive income like I do, look for solid, sustainable dividends. And number 4, the PEG ratio. It's basically the PE ratio adjusted for growth. If the PEG is less than 1, it might be a solid growth pick. Part 3, case study. Okay, let's do a real-life fundamental analysis of a stock. And in this part, we're going to study Apple, ticker symbol AAPL. All right, let's break down Apple's financials. We know it's a tech giant, but is it actually a good investment based on the numbers? Let's dive into its fundamentals and see if the stock is worth holding. First up, the revenue. In 2024, Apple pulled in $391 billion, a 2.02% increase from last year. That's a steady growth, but revenue alone is not enough. The real question is how much of that actually turns into profit. So Apple's net income came in at $93.7 billion, meaning for every dollar Apple makes, about 24 cents turns into pure profit. That's a profit margin of nearly 24%, which is insane for a company this size. But here's where Apple truly flexes its financial muscles. Cash flow. Apple generated $118 billion in operating cash flow, meaning this is real money flowing into the business, not just accounting tricks. After spending $9.4 billion on capital expenditure, things like new facilities and research, they were left with $108.8 billion in free cash flow. This is the money that Apple can use to reinvest, buy back their shares, or pay dividends. A company with this level of free cash flow, that's the kind of business that can survive economic downturns and still reward investors. So what does this mean for Apple as an investment? Steady growth revenue, massive profits, strong free cash flow. Apple isn't just making money, it's keeping money. And that's what separates a good company from a great stock. But here's the real question. At today's price, is it still a buy? All right, now you know how to do some fundamental analysis on a stock. And we just did some case study fundamental analysis on Apple. Now you might be wondering, is Apple a buy at this time? At its current price? Well, that's where valuation comes in. A great company doesn't always mean it's a great investment right now. In the next video, we'll break down how to tell if a stock is overvalued, undervalued, or priced just right. Like that Goldilocks and the Three Bears story. So you don't end up buying at the top. Don't forget to subscribe and hit that bell notification for that next episode. And as always, for more finance, investing, real estate, and macroeconomics, let's all learn wealthy together, and I'll see you in the next video.